Moderna, once hailed as the poster child of biotech innovation, the company that brought mRNA technology to the forefront and helped deliver life-saving vaccines in record time. But while the world was watching Moderna change the course of a global pandemic, 5 analysts completely fumbled the ball. Some missed the opportunity altogether, blind to the potential right in front of them. Others recklessly rode the hype, singing praises all the way to unsustainable highs. A few cried buy when it was time to sell, and sell when it was the perfect moment to buy. But one common theme exists: they all got it completely wrong. How could these so-called experts fail so miserably at predicting the future of a company so integral to the pandemic recovery? Today, we're not just here to drag them for their incompetence. We're going to break down how you, as an investor, can avoid falling into the same traps. Because if there's one lesson from this mess, it's that following the crowd can cost you big time. And speaking of avoiding costly mistakes, there's a cutting-edge tool that's changing the game for content creators: AI. Imagine being able to leverage the same kind of advanced technology that powers biotech breakthroughs to also supercharge your YouTube channel. If you've been struggling to grow, stand out, or even know what direction to take, AI could be the key. Matt Parr's Tube Mastery and Monetization course teaches you how to use AI to not only streamline your content creation, but to actually boost your channel's success. Those who learn to use AI effectively now will be light years ahead of the competition. Don't wait until it's too late. Click the link in the description and get started today. Welcome to the incompetence court. You won't believe the financial blunders these analysts missed. From crucial earnings forecasts to the staggering potential of mRNA technology, they completely dropped the ball, leaving investors in the lurch. What were they thinking? How could they overlook such monumental opportunities? Stay tuned, because we're about to peel back the layers of confusion and incompetence. First up on the stand is Edward Tentoff of Piper Sandler, who not only misjudged Moderna's trajectory, but absolutely blew away the incompetence meter with his misguided calls. Being charged with gross incompetence, Edward began his coverage of Moderna in early 2019 with a series of overweight calls that essentially matched the price of the stock. He even had an overweight call that lowballed the price at $226 when it was trading at around $417 in August of 2021. Overweight lowball? I don't even know how you do that. But he quickly retracted this with a bipolar neutral overweight a day later. Okay, not horrible, as he at least began to segue into warning investors as the stock was about to peak. But unfortunately, he quickly segued back into outright overweight or positive calls, which were ridiculously overpriced, and stubbornly held on to this thesis to the bitter end, while yet again playing chase and cheer, only this time into the trenches. Absolutely mind-boggling. Edward buddy, not sure what Kool-Aid they are pushing at Piper Sandler, but you are supposed to overbid on the way up, not on the way down. Guilty as charged and sentenced to a life of unpaid number crunching with Martha Stewart. Michael Yee of Jeffries is being charged with financial massacre. If you had listened to this guy, you would have sold when you were supposed to buy, bought when you were supposed to sell, and dished out your savings into a bunch of reckless calls that would have earned you a spot at the local homeless shelter. Absolutely egregious. Michael began his coverage of Moderna in July of 2020. Surprisingly, he began touting the stock bullishly with a series of buy calls, only to retract to a hold position, all of these calls clearly chasing the stock price. He then made a bipolar positive call, only to retract again into a series of holds that lasted through the largest run of the stock's life, and then on its way down as well. Then after the stock was in the trenches in December 2022, he essentially segued into a series of overpriced hold buys and into full buys, only to retract again into a hold buy that he holds to this day. The judge hereby accepts his insanity plea, sentenced to 10 years at the institution for the financially insane. Salveen Richter of Goldman Sachs began covering Moderna in early 2019 and didn't hesitate to grab her pom-poms and begin cheering this stock on as it rose to the pinnacles of wonder. She began with a series of buy calls, essentially playing chase and cheer with the stock price on the way up to its peak, only to grossly overbid the stock by around 34% after the peak hit and the crash began. At one point, her overbid sat at a whopping 236%, and she stubbornly holds this ridiculous thesis to this very day. So she played it safe, cheering and chasing on the way up, only to go all in and overbid on the way down. What was this lady thinking? Definitely sentenced to 10 years with her friend Michael in the asylum for the financially insane. Hartaj Singh of Oppenheimer is being charged with gross incompetence. He began his coverage back in 2019 and jumped in headfirst with a series of outperform calls before the initial ascent that essentially matched the stock price. Then, as the stock peaked, Hartaj gave a perform or neutral call, which he held until early 2024. And he continues to hold the general thesis with a slightly overbid price target today. To be completely honest, we've certainly seen worse here on incompetent capital. Had he called outright sell when he decided to go neutral, he would be getting an award here. Still, claiming neutral when you should be warning investors is bad practice that we have been exposing on this channel left and right. Essentially, we believe that analysts often are pressured unofficially to act as relationship managers between their firms and the companies that they are supposed to be honestly reporting. Conflict of interest? You betcha. Guilty as charged and sentenced to analyst probation and drug treatment. Luca Issi of RBC began much later than the rest, but he didn't hesitate to jump right in and begin cheering the stock as it sat in the trenches. And as it tested new lows, he played chase and cheer. And finally, after all of his victims were bankrupt, he decided to throw in the towel and segue into a sector perform or neutral call, which he holds to this day. No analysis needed, the chart says it all. Guilty as charged and sentenced to a life of making actual financial decisions based off of his recommendations. As we've seen, the analysts brought before incompetent capital's court repeatedly failed to grasp the nuances of Moderna's journey through the pandemic and beyond. Whether it was Edward Tenthoff's ill-timed calls, Michael Yee's financial whiplash, or Salveen Richter's baffling overbids, each misstep was a stark reminder of the dangers of blindly following market hype. But how did we get here? How did Moderna rise to such dizzying heights, only to face these analyst blunders? To fully understand their mistakes and Moderna's trajectory, we need to take a step back and examine the company's history, the groundbreaking technology that catapulted it into the spotlight, and the evolving biotech landscape that left even the most experienced analysts scrambling. Let's dig into the background that sets the stage for this remarkable story. Disclaimer: incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. Moderna, founded in 2010, was once considered a pioneer in mRNA technology, which promised to revolutionize the treatment of various diseases. The company gained global attention with its rapid development of the COVID-19 vaccine, catapulting its stock price to new heights during the pandemic. Investors and analysts alike were captivated by the company's potential, buoyed by its unprecedented success in addressing the global health crisis. Moderna's swift vaccine rollout seemed like the beginning of a biotech revolution, with its mRNA platform poised to tackle other diseases, from cancer to rare genetic disorders. The company's partnerships with governments and pharmaceutical giants further strengthened its reputation, making it one of the most watched stocks on the market. However, what many analysts missed was that Moderna's success was heavily dependent on the unique and temporary circumstances of the pandemic. Vaccine demand surged during the peak of COVID-19, but this demand was not sustainable long-term. As the world adjusted to living with the virus and competing vaccines entered the market, Moderna's dominant position began to erode. Analysts focused heavily on Moderna's early success, failing to account for how the market dynamics would change once the urgency of the pandemic subsided. The company also faced challenges in transitioning from a pandemic-dependent business model to a diversified pipeline. While Moderna had other mRNA-based products in development, these were far from guaranteed successes, and the complexities of bringing new drugs to market were vastly underestimated. The initial optimism around its vaccine platform led to inflated revenue projections, but the realities of drug development and regulatory hurdles started to weigh heavily on the stock. Analysts largely ignored the slow progression of Moderna's non-COVID products and the risks associated with pivoting to other therapies. Financially, Moderna's performance was closely tied to its COVID-19 vaccine sales. Once these revenues began to decline, the company's stock took a significant hit. The analysts' bullish calls often overlooked key financial indicators, such as diminishing margins and declining vaccine prices as competition ramped up. Moderna's high stock valuations were driven more by hype than by realistic projections, and as the market corrected, the stock tanked. Analysts missed the warning signs of market saturation and growing competition in the mRNA space, leaving investors with overinflated expectations. The company's reliance on its vaccine revenue stream, without a diversified portfolio to fall back on, was a fundamental flaw that many overlooked, resulting in a dramatic fall from its pandemic-fueled highs. In accounting, non-recurrent expenses, or one-time charges, are viewed as isolated financial events that do not represent the ongoing operations of a business. These might include expenses related to restructuring, litigation settlements, or natural disasters, all of which are unlikely to repeat. When assessing the long-term health of a company, it's essential to distinguish these extraordinary items from the core operations that actually drive sustainable profitability. Similarly, non-recurrent income, such as a sudden windfall from an extreme event, should be handled with caution. This concept ties closely to exogenous circumstances, like the COVID-19 pandemic, which propelled Moderna to astonishing heights due to a unique and temporary surge in vaccine demand. However, just as non-recurrent income in a financial statement isn't expected to continue indefinitely, neither should we expect extraordinary events, like a global pandemic, to sustain a company's long-term revenue growth. Analysts and investors who bought into Moderna without considering the temporary nature of the pandemic-driven boom were essentially treating it as if this sudden surge was a part of the company's normal course of business, which is a fundamental mistake. They overlook the fact that the stock market often reacts emotionally to such short-term catalysts, leading to inflated valuations that don't reflect the company's true, sustainable performance. This brings us to Benjamin Graham's famous analogy of Mr. Market. Mr. Market is an allegory for the stock market's emotional and often irrational behavior. Some days, Mr. Market is wildly optimistic and offers prices that seem too good to be true. Other days, he's in despair, offering stocks at a discount as if the world were ending. Investors who follow Mr. Market's mood swings without doing their own due diligence often get swept up in the hype, just as many did during Moderna's meteoric rise. They saw pandemic profits as indicative of a company's long-term potential, ignoring the temporary, non-recurring nature of those revenues. The lesson here is twofold. First, treat one-time windfalls or income from extraordinary events with skepticism when valuing a company. Just as an accounting professional adjusts for non-recurrent expenses, investors must adjust their expectations for revenues driven by unique, temporary circumstances. Second, avoid falling prey to market euphoria. When Mr. Market is in a frenzy, step back, assess the fundamentals, and remember that stock prices can, and often do, misrepresent the true value of a business. Investing is about buying into a company's sustainable future, not riding the emotional highs and lows of short-term events.